If someone handed you $1,000 right now and told you to invest it, what would you actually do? Most people freeze, not because they're not smart enough, but because nobody ever broke this stuff down simply. Index fund, mutual fund, hedge fund, ETF, these terms get thrown around like everyone already knows what they mean. By the end of this video, you will. And more importantly, you'll know exactly which one is built for someone like you. So leave a like, subscribe, and let's get into it. What is a fund? Before anything else, let's get one thing straight. What is a fund, actually? Think of it like a group order. Instead of one person buying everything, a bunch of people throw their money into one pot. That combined money gets invested across dozens or hundreds of assets, stocks, bonds, real estate, and everyone shares in whatever the result is. More variety, less risk, and none of you have to manage it individually. That's a fund. Simple. Now, let's talk about the 4 types. But before that, if you like more content like this, make sure to hit that subscribe button so you don't miss out on future videos like this. And I hope you enjoy the rest of this video. Index funds are probably the most talked about type right now, and for good reason. Here's what makes them different. An index fund doesn't try to pick the best stocks. Instead, it just copies a list called an index of companies. The S&P 500, for example, is an index of the 500 biggest companies in the United States. Apple, Microsoft, Amazon, they're all in there. An index fund that tracks the S&P 500 just buys a piece of all of them automatically. No guessing, no strategy. Just follow the list. And here's where it gets interesting. Because nobody's doing any stock picking, the fees are almost nothing. We're talking 0.05% per year in 2024. That's $2.50 a year on a $5,000 investment, less than a coffee. Now compare that to the alternative, paying a professional to actively manage your money. And most of those professionals still lose. According to Morningstar, only 21% of actively managed funds survived and beat their index counterparts over the 10 years through June 2025. The S&P 500 has averaged roughly 10% annually over the last 100 years. Low cost, consistent, historically reliable. That's the index fund case in a nutshell. One thing worth knowing, you can only buy or sell an index fund once per day after the market closes. That price is called the net asset value. It's not instant, but for a long-term investor, that honestly doesn't matter. Mutual funds. Now, here's where a lot of people get confused, because mutual funds look almost identical to index funds on the surface. They both pool money, they both invest across different assets, but the key difference is this. Mutual funds are actively managed. There's a real human, a fund manager, deciding what to buy and sell, trying to beat the market. That sounds appealing, right? A professional working on your behalf? But here's the catch you need to hear. Active management costs more. The average actively managed equity mutual fund charged 0.64% per year in 2024 versus 0.05% for index funds. That gap seems small until you do the math. An investor starting with $100,000 earning 4% annually ends up with $208,000 after 20 years at a 0.25% fee, but only $179,000 at 1% fee. That's $29,000 gone, not to the market tanking, but just to fees. And remember, most of those managers still didn't beat the index anyway. That said, mutual funds aren't useless. They can make sense if you want exposure to specific sectors or markets that aren't easily available through a basic index fund. Just go in with your eyes open. Same trading rule as index funds. Orders are processed at the end of the trading day. Hedge funds. All right, now we enter a completely different world. Hedge funds are not for the average investor. Full stop. But you should know what they are. Hedge funds are private investment funds for wealthy individuals and institutions. We're talking about strategies like short selling, betting that a stock will go down, borrowing money to invest even more, and using complex financial instruments. They have a lot of freedom to make aggressive moves. That freedom can create huge returns. It can also create huge losses. And the fees? legendary. Hedge funds typically run on what's called the 2 and 20 model, a 2% annual management fee just for being in the fund, plus 20% of any profits. So if your hedge fund earns $100,000 this year, $20,000 of that goes to the manager, on top of the 2% they already took. Win or lose. To even get in, you generally need to be what's called an accredited investor. In the US, that typically means a net worth above $1 million or an annual income above $200,000. If that's not you right now, don't lose sleep over it. Hedge funds are the velvet rope section of investing. Interesting to know about, not where you need to be. ETFs. Okay, back to something actually useful. ETFs, or exchange-traded funds. This is where things click for most people, because an ETF is essentially an index fund with one major upgrade. You can buy and sell it anytime the market is open, just like a stock. With a regular index fund, you place an order and wait for the market to close to get your price. With an ETF, you see the price moving in real time and can execute immediately. That flexibility is a big reason ETFs have exploded in popularity. The fees are just as low. Some S&P 500 ETFs charge as little as 0.03% per year. And here's something most beginner videos skip entirely. ETFs are significantly more tax efficient than mutual funds. In 2024, only 6.5% of U.S. stock ETFs distributed capital gains to investors, compared to 78% of mutual funds. That means with an ETF, you're far less likely to get hit with a surprise tax bill just for holding it. Plus, many brokers let you buy a single share, so you can start with whatever you have. ETFs are the most accessible, flexible, low-cost option on the table. So here's the simple version. Index funds and ETFs, low-cost, passive, built for long-term growth, available to everyone. Mutual funds, higher cost, actively managed, useful in specific situations, but most don't beat the market after fees. Hedge funds, aggressive strategies, extreme fees for high net worth individuals only. If you're watching this, there's a very high chance that an index fund or ETF is where you should start. Not because it's the boring answer, but because it's the one backed by data. If you had invested $10,000 in the S&P 500 in 1995, you'd have over $190,000 today. No hedge fund manager, no active trading, just patience. So if you want to know how to invest in ETFs as a beginner, make sure to watch this video till the end. I'm sure it's going to help you a lot.